What the market taught me in 2018 was this uncertainty and volatility is here to stay, but it will create a lot of buying opportunities.
In these uncertain times, it's about dealing with the known unknowns and then trying to also take into account the unknown unknowns. A bit of a tongue twister.
The big question is, how does one attack the later stages of a bull market? There's a really good quote there from Peter Lynch. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than there has been lost in the corrections themselves.
At the moment, it's all about price momentum. That doesn't end well. What we want to do is find a company that can generate good, sustainable cash flow through the cycle. But you also need to value that cash flow. You can't pay too much. Valuation does matter.
If we roll the clock back 6 months ago or even 12 months ago, everybody was worried about rising US interest rates. They rose 3 times and now at 2.5%. The US Fed is actually reducing its balance sheet, it's tightening up, selling bonds rather than buying bonds, so it's actually pushing interest rates up both at the short end and the long end.
People don't realise is US mortgages are fixed for the life of the loan. And in other economies where it is a variable level of interest, their typically source of funding, for example as Japan, is Japanese households. So they're not reliant on overseas capital. That's our Achilles heel.
What we've sought to do is have a range of funds that allow investors to have low risk, lower return profiles, but also create vehicles where we start to provide investors with participation rights in terms of equity upside.
At some point there's got to be a deleveraging, and that will have a negative effect on growth. Long-term investment in quality businesses exposed to structural tailwinds will steer you safely through these turbulent times.